Hey everybody, thanks for joining with us just at the top of the hour here. So we'll kind of kick things off and talk through a few self-insurance items today. I know we're going to be discussing kind of the pros and cons, if you will, as also when to be educated on it and also when to potentially make that jump into it. I am Kevin Handzlik. I head up the employee benefits here at Ellerbrock-Norris, and I've got our CEO next to me, Andy Bassett. So Andy, why don't you kick it off and kind of talk through who we are as Ellerbrock-Norris?
Yeah, excited to be here. Thanks everybody for joining. So I think just to frame maybe today's conversation, I'll give a little bit of who we are at Ellerbrock-Norris and maybe a lens to think through as we have today's discussion.
Yeah.
But to set the stage, I guess at Ellerbrock-Norris, we look at risk in a consultative capacity. So we're going to discuss that a little bit at a high level today and obviously dive deep into one specific piece of that when we talk about benefits and we talk about the consideration to go self-funding in our benefits. So that's a lens I want everybody to think through is kind of this holistic risk management philosophy and thinking. One way, thanks Cam, you had gone ahead for me. The Protect Your Purpose brand tagline, I think that kind of summarizes everything or says it all. Our goal at Ellerbrock-Norris is always to deeply understand our clients, the businesses, the owners, the executives, what their purpose is, and then build the plans and strategies to help them ultimately protect that purpose, right? And so, we're constantly talking about holistic risk management. And for a business owner and the leaders, that means what are the risks inside our business? What also are the risks that affect them in their personal lives outside of the business? And then, of course, what are the future risks and goals they may have when they're no longer in the business? So, we think of the brand tagline, we think my life or my business, my life, my future, right? And so when we talk about risk at Ellerbrock-Norris, if it'll skip ahead, there we go. We talk about it, we think the 10 impact areas of risk, okay? And so for everybody that's watching this, we're going to talk today about employee benefits and retention, right? And we're going to dive deep, and we're going to talk about the transition to self-funding. But for the group, I want everybody to think about how when we build plans and strategies specifically in the employee benefits and retention space or one impact area, how that can coordinate and touch many others. And so we think about employee benefits, what we're going to talk about today, again, as I repeat. It can also impact like our key people, right? Yep. And how we retain those people and build plans to, build future plans for the company through those key people. Or we think about compliance, ACA and all the things. So if we build really strong plans and strategies around our benefits platform, we're going to touch multiple other areas. So again, I think the lens I want everybody to look through and the lens we're always looking through here at Ellerbrock-Norris is while we're going to talk about one specific area and one specific thing within that area, which is to consider self-funding, also think about how that can impact multiple areas in the organization with a solid plan or strategy.
Yeah, and I think on top of that, as you see this slide here, one thing that self-insurance can do and an employee benefits plan can do ultimately, like we've seen, is, we're not looking at a 12-month decision. Now, those are some of the things that we do look at renewal time. But the decisions that we would be making, on the screen and in the self-funded arrangement is, a 5, a 3, a 5, a 10-year plan out. And we want to make sure that we keep that in mind as well, too.
Yeah, absolutely. And then the last thing I'll add is, as the CEO and the owner of Ellerbrock-Norris, or one of the owners of Ellerbrock-Norris, I also have the lens of what it is like to go from being fully insured to self-funded. So I'll be able to provide some context along the way in the conversation about our experience. And then, of course, at the end, we're going to have a real expert, a special guest talk about her experience. So at that, take it away, man.
Yeah, absolutely. So just to kind of highlight here, a few of the things that we're going to be discussing, first is just the alternative funding knowledge. So making sure that we know, fully insured, level funded, self-insured differences and some of the key points to highlight there. Another piece is the misconceptions that we hear from not only clients when we're educating on that, but also prospects that we talk about as well too. And then obviously dive into the benefits of self-insurance, especially when it comes to cost containment, employee programs, and incentivizing employees to make better financial decisions for themselves and the employer. And then finally, we'll talk through some long-term stability pieces because, again, as I touched on, we're looking at a 12-month renewal, but what we're really doing is looking at long-term stability and long-term success in a benefits plan.
And I think from my perspective as an owner, as a leader of an organization, that long-term stability is such a big piece of this conversation because it allows us to make the most informed decisions in our organization when we feel like we have stability, certainly around something that can be a pretty high cost our
Absolutely.
organization.
Absolutely.
So, yeah, big deal.
So the first piece that we're going to touch on is just the the alternative, there we go, we got it. The alternative funding arrangements here. So really what there's obviously some differences between these as well too, but fully insured, level funded, and self-insured. The main differences here that we see are going to be cash flow. It's going to be the transparency in claims and understanding the data. And then it's also going to be plan customization. So under a self-insured plan, what we're discussing today, the cash flow is what you spend on claims is what you spend that month. Whereas on a fully insured or a level funded plan, it's much more, here is our premiums that we set at the beginning of the year. That's what we're going to be spending on. And then any surplus or difference really usually stays with the carrier. On top of that, it's the claims transparency. So in those monthly, kind of claims costs, we get to see much more detail on where are we spending those dollars? Where are our claims going towards? Is it emergency room stuff? Is it surgeries? Is it ongoing chronic conditions? We just have that level of visibility into it. And then finally, I think the plan customization is huge. You as an employer, we'll touch on this in the next slide. I kind of gave a precursor, but you are in control as the employer on a self-insured arrangement. And I think more and more as we see the cost of insurance increase on the healthcare side, that control is pretty essential.
Yeah, absolutely. And by the way, we didn't say it earlier, there is a chat feature to pop questions in. So please, as you go, put a question in and we're happy to answer it along the way. This is as interactive as a webinar can be, right?
Yeah, sure, for sure.
Anyway, but yeah, all good points.
Yeah, definitely. So, and again, to that point, it's really just going to be looking at the control piece. So on the next slide here, we're going to touch on, there we go. On the next slide here, we're going to touch on the, where is the control? So on a self-insured arrangement on a standalone or through a captive, whatever that may look like, there is a ton of control at the employer level, and using the resources that you have at your fingertips with a benefit advisor, a claims payer, a pharmacy manager, having that control all together and kind of moving in lockstep together is something that we see a lot of employers starting to look into more heavily.
Yeah, and I think the control piece is such a big element of what we experienced at Ellerbrock-Norris. I mean, you come from the fully insured space, and control would certainly not be anything a consumer of a fully insured health insurance program would define as having.
Yep.
And you take the step into the self-insured platform and the data and the information you get and the ability to be able to control things and messaging and how you go about creating consumerism of healthcare. That's a big deal. And so I think control for people, I want to highlight that a lot because that was a big piece of what attracted us as an employer.
Mm-hmm.
And of course, a lot of what we communicate as an advisor to our clients.
Yeah,
Cam, we got a couple questions coming in. Do you want to?
Yeah, for sure. One of the questions was giving a sample breakdown of prescription costs and copays and what an employee would pay. We'll touch on it a little bit later in the presentation, but if that doesn't get answered or you have anything further, definitely shoot it back over into the chat. That will definitely touch on a lot of prescription stuff, that's for sure.
And then as far as copies of the presentation, somebody asked about that. We will send, Cam, correct me if I'm right, we send a copy of the recording out. So, yep, that'll be coming.
Perfect. So first thing that we want to touch on is, when we start to have these conversations with employers is what's kind of a misconception or thoughts that employers have that maybe haven't gone through the process of educating around self-insurance. First one is it's for large employers, right? That's kind of the connotation that has been what we've seen a ton. And, what we really want to talk through today is how that can be a thing for a small employer, mid-size and large as well too. And we've got some good examples that I think we'll go through. The next piece is going to be, that seems like a lot of work. We don't have the resources and things of that nature. Now, in a self-insured arrangement, you have a lot of different moving pieces at times. It is a little bit more of a complex arrangement, but those moving pieces, we always advise, as a benefits consultant, as a third-party administrator, as a pharmacy manager, those are all pieces of your team that are supposed to be working together and in lockstep. And that's what we like in a self-insured arrangement when we have those partners that do that. And then finally, I would say the biggest one that we see is Well, our claims don't, you know, match up well, or what if we have a really bad year that's too risky? A lot of the time, I think a lot of individuals, and we'll touch on it here in a sec, don't understand that, you know, most self-insured employers have kind of what we call stop loss. They have a stopgap of where claims really stop being paid by the employer. And that's why we, you know, purchase that insurance. So we're going to talk through a few of these misconceptions and just educate around how we can solve for a few of these pieces.
And a couple points on that slide. I mean, certainly our team, you know, the risk understanding as we made the transition, what that meant. You know, we have different levels of risk tolerance, you know,
sure.
and the leaders in the organization. So when you go through that conversation and deeply understand it, you can get comfortable pretty quick. Number one. Number two, on the first point for large employers only, you know, when Ellerbrock-Norris made this transition, which is 5 years ago, roughly, you know, we were 30,
Yeah,
35 people max on the plan at the time. So, you know, long ways from a large employer, right? But so the ability and availability to get into these financing mechanisms are becoming more and more accessible
absolutely.
to, you know, average everyday employers. for lack of a
For
better term.
sure.
So yeah, anyway.
So kind of hitting on that stop loss piece. So there's really two different ways to look at stop loss. There's a individual level and then an aggregate level as well too. So the individual level, as you see here, specific stop loss on the left-hand side, that's going to be based on the per member. There's a set amount, kind of like a threshold, if you will, that you'll decide with the benefits advisor. You'll make a kind of a decision for your risk tolerance as well too. By rule, we typically see smaller employers have smaller thresholds. It just makes the most sense for the risk tolerance of the organization. But that first layer is at this certain level, let's call it $50,000. Anything above that from a claims perspective, that's where your stop loss insurance kicks in and reimburses you as an employer. So if an employee incurs, because of a really tough year for them, they incur $100,000 of claims, you know where your limit is as an employer and where you're going to stop. That's on the individual side. And then to cover on the aggregate side or on the full group side, we have aggregate stop loss insurance as well. So the underwriting team is going to deem what 100% of expected claims are. So what do we expect your group to spend in a year? Then they add a layer, a corridor is what they like to call it, of 20 to 25%, depending on who you're working with. That level is what you would be paying up into a max claims cost. So anything on top of that is why we pay for that aggregate insurance. Now, the insurance companies and underwriting, they're really good at this calculation. So going above that 125 or 120% is definitely the lower probability of the two. And you see that in the premium that you would pay for this type of insurance. But there are two really big key mechanisms that I think a lot of employers don't realize when they hear self-insurance. And these are definitely ones that we want to talk through.
Well, and then you mentioned risk, we both mentioned risk tolerance, and that's a big piece of this is you get an opportunity to talk through as an organization, what is our tolerance for risk? How do we structure it to make sense for us? Number one, specifically early on, like the first transition. But one of the things I learned as we did this is once you start to see data, understand your group, understand the levers you can pull to better control, you know, risk and how you become consumers of insurance, your workforce does, your team does, you can start to understand and make adjustments to this. You can get more comfortable taking on more risk because you feel like you actually have more control.
Absolutely.
And so it does allow you flexibility as you learn over time how you're going to perform as a group. So
yeah, absolutely. And I think the piece on here of just re-looking at this year over year, and then also being able to be consultative on, okay, this is what we've done in the past. Here's how our data has affected that. Now, where do we want to go into the next year to 2 years and creating that plan?
yeah, well, and I know you're going to talk about the tools and levers that can be pulled to, you know, better control risk, but I want people to think back to this when we talk about that is when you start to implement those plans and strategies,
Yep.
that's where you get a lot more comfortable to understanding maybe we're comfortable taking on more risk to reduce costs on the front end, bet on ourselves.
Yeah, absolutely. And so kind of more of a visual look on different stop loss. So obviously the individual on the left-hand side, again, that $50,000 deductible per individual. Once we hit that level, that light blue on the chart, that's where what we're paying for this insurance kicks in. And one thing that we have a lot of employers that are so vigilant on their data, and they'll say, hey, we're approaching, and they kind of look at it in a negative light. there's a reason why we pay for stop loss insurance. Having a stop loss claimant hit or 2 or 3 is not the end of the world because of the fact that it's kind of like insurance. When you're paying a premium for something and you're not getting any value or any utilization out of it, not necessarily what you're looking for. It's wasted dollars in a sense. So one of the pieces here is just understanding that each individual is going to have that level, and anything above that, we as an employer are going to start being reimbursed. And so we kind of know our max from an individual, and then showing what that looks like on the aggregate level. You're much, much more likely to have an individual stop loss hit than an aggregate stop loss hit. But something that we just want to know as an employer making a decision from fully insured or level funded into self-funded, there is that max, or there is that, it's not unlimited risk.
Yeah, so the protection's created both ways.
Exactly. And from your perspective, like when you took Ellerbrock from fully insured into a self-funded, how did you kind of look at that risk, knowing that those protections are in place?
Yeah, I mean, it goes back to what I said earlier. I think how I looked at it initially versus how I look at it today are two different things. We've learned a lot along the way, right? We understand the data, we know the tools, levers, the education we've given our team to better control risk. So, early on, I think our tolerance for risk was a little more hesitant, so we were a little more conservative in how we structured this. And obviously that comes at a little bit higher guaranteed costs on the front end for us. But over time, we've gotten more comfortable because, again, we know our performance, we know the education, we know the things we're doing, the tools that we've implemented, that we're getting more comfortable, raising our stop loss exposure and risk a little bit to reduce, guaranteed costs on the front end. And so I think it allows you to be able to get flexible and creative and understand your risk tolerance over time.
Yeah, and Ellerbrock over the past 5 years has doubled their stop loss deductible. So it started lower and is now double in 4 years, which is just kind of proof to that as well. The key benefits, obviously we talked about misconceptions and how we can combat those. Some of the key benefits though are the flexibility in the design. So how can we incentivize employees to be better utilizers of health insurance? And how can we also have a lot of control as an employer to figure out what do we want to cover? What are some creative things that we've heard about that we look into that we want to add to our plan? That's one big benefit that we'll touch on. And you're going to hear it a ton. I know Andy's already talked about it, myself as well, the data. Knowing where your dollars are going, because health insurance most times is your second or third largest line item as an employer. Where is that going and what is it for? I think is something that can be extremely valuable for an organization, not only to just understand, but then also to plan ahead and plan forward. And then lastly, how can we actually shift the curve of claims costs? I think we hear it all the time, and you guys have probably experienced it. Well, health insurance, it goes up 10% every year. Well, yes, there are years that you can have bad years and things can increase, but are there ways that we can actually impact claims costs and save money? And that's what self-insurance allows you to do.
Yeah, I mean, you're exactly right. And the thing that has always resonated with me from the beginning of us diving deep into this has always been consumerism, right? How do we become better consumers of healthcare? Because by nature, we just aren't very good consumers of healthcare, meaning we don't know how to go access it well, and it means it gets expensive or the utilization's not ideal. And then you think about too, as employers, the benefit we're providing is to our team, that also, if we're not giving them the education and the tools and the resources to become the best consumers of healthcare possible, it ultimately results in our cost burden over time.
Yeah.
And so again, data allows us to, because it's one thing to throw ideas at people, give people tools, but like if they're not the tools that are going to move the needle based on what the data tells us, then really we're not going to see any results. But if we're getting data, we understand what is actually going to move the needle, and then we can go communicate, educate, give the tools to make our team better consumers of healthcare, then we've got control and we can start to see cost reduction and then reinvest that back into our team.
Yeah, and it kind of comes down to, you get your data, okay, so what?
Yeah.
We always talk about the now what. How do you utilize your data in a way that can educate employees on how to properly use it? We see emergency room as always a big thing. Like, how do we utilize emergency room comparative to urgent care, comparative to telemedicine? Just simple things like that we can see in the data and take, really corrective action right away is a big thing. This chart here really kind of sets a stage for how we're going to approach here moving forward. So on the far left side, we've got fully insured. Just all of those different pieces are fixed costs. So we talked about, the cash flow piece early on in the presentation. All of these pieces are bundled up and together into one premium that you're paying based on the enrollment in that tier, in that plan. So all encompassing there, you're paying that on a monthly basis. Moving over to the self-insured side, we have that stop loss premium and we have the administration that are going to be on the fixed side of things. So we touched on that briefly. The big portion that we want to discuss and what will be a big kind of a key point moving forward is where do we have the savings opportunity? Where do we have the control? The fixed costs are the fixed costs.
Mm-hmm.
But the claims expense and your claims on a monthly basis and an ongoing basis, that's the biggest piece. One thing that I think even employers who we have that are self-insured don't always realize is your variable costs, meaning your claims, they can make up 70 to 85% of your overall spend. So not trying to get bogged down in the fixed piece of it, more how do we be proactive and manage where we can actually manage is a huge piece.
Yeah, this always was eye-opening to me when I was first exposed to this.
Yeah.
This slide or this information is the biggest portion of the actual costs are to a degree controllable.
Yeah, absolutely.
Yeah.
And able to be visible and educate around as well too.
Absolutely.
So another key piece that we found at Ellerbrock and a lot of our clients and prospects have come to like is the advocacy piece. So with, as you see on the bottom of this chart, your standard plan is your employees are going to go and pay deductibles and co-insurance and co-pays and all of that good stuff, and not really have any middle person there other than your HR teams and other individuals that are at the organization. What we found to be really effective is when moving to self-insurance, it's one move as an employer, but it's also a move for the employees. We want that to be as seamless and also beneficial as possible. We don't want to take any benefits away. We only want to enhance it. So what we found is advocacy. So when an employee goes out and they are needing a procedure done or needing a surgery or have a question on, is this the best, cost for prescription for me? We want to be able to have an advocate that walks alongside them and really kind of guides them. Now, what we found is that's great, but we have to incentivize employees to do so. And an employee that if you go to some of your employees and say, hey, this will lower the cost for us as an employer if you get into there. Now, there's going to be some great employees that are willing to do that. But I guarantee you the increased utilization happens when you incentivize an employee to say, hey, here is a free benefit for you. If you go through this process, we're gonna take care of your deductible. We're gonna take care of your copays. It's a true win-win as an employer because there's cost savings significantly, like we'll touch on, that could be had. And it's also a benefit to the employee because that's a benefit that they weren't receiving before on the fully insured or level funded side.
Yeah, and I love that because not only do they get the benefit of potentially having deductibles, paid for, or all these different things, but also having somebody navigate them through the process of needing to utilize healthcare, right?
Sure.
People, again, going back to we're not great consumers, we get lost, and having an advocate that can help us navigate through it. So we're providing a platform that is allowing us as the employer to do all the things we've talked about to this point, but we're also creating an environment where we give our employees, our team, the opportunity to be more successful and actually feel like their benefits are a benefit again.
Yes.
Right? I mean, that's such a big thing is benefits are not inexpensive for employers to invest in. We certainly want our team to feel like they're a benefit, not a burden.
Absolutely.
And this can be one way to help.
Well, and what we've found is a lot of the incentive and the advocacy has just boiled over into kind of word of mouth as well too. So it's like I was an individual that had X happen to me. Well, this went really well and it was very smooth in the process and I got it for free.
Yeah.
And I mean, that talks good and bad things talk, obviously, and this is one of those ones that we're excited about in a self-insured arrangement.
Absolutely.
So with that advocacy, we talk about different programs that you have available and different ways that we can carve out things on the self-insured side. We're just going to touch on 2 slides worth of the ones that we found to have the most benefit and value. The first one being on the RX side of things. Specialty RX programs, independent PBM models, so pharmacy benefit manager. It allows us to have access into certain features. There's fully insured and level funded where the pharmacy, the claims, and the network are all under one carrier. Whereas on the self-insured side, we can get independent. And what that means is we have more transparency and more ability to kind of carve in and out of things. So from a RX side of the equation, we have international RX. We've got Mark Cuban cost plus drugs. We have a bunch of different areas where we can really tap into to ultimately find the lowest net cost. It's kind of a misconception, but international sourcing of drugs, it's actually manufactured in the United States, shipped across US lines, just warehoused, and then shipped back over at a lower dollar cost. So there's a lot of different ways that we can get creative. And again, employees go into these programs at zero cost to them because of the savings that the employer can see. That care navigation piece is exactly what we were talking about with the advocacy. And then one that has been real near and dear to like our hearts here and our clients is surgery and imaging. Going to preferred imaging and surgery centers in and around your area as an employer can save significant dollars, taking it away from the hospital system and moving it into a more surgical center, if you will, for not only imaging, but surgeries in itself.
Well, and the thing that I think I want to highlight there, because we learned this, is not only are we able to create opportunities to reduce costs at the employer level when it comes to, say, a surgery or imaging, we're also giving access to that employee the best care.
Yep.
You know, they're getting access to the best surgeons or the best imaging at, ironically, a reduced cost.
Yeah.
It's mind blowing when you can actually break that down and see how that works.
Exactly.
And so again, none of this is designed to reduce costs and take away from our employees. Obviously, it's actually the opposite. We're able to do two things simultaneously: reduce and control costs while giving more to our employees. And that's an example where we're giving them, access to better care. It looks like we did get a question come in that says, do you suggest a TPA for self-funded medical insurance?
Yeah, good question. It really, and this is like the cop-out answer, right? But
it depends.
It depends, yeah. We really evaluate TPAs. Now, there's like 3 to 4 that we feel really strongly about and provide great service as well as strategic. That's where we really like to fall, because that's at Ellerbrock. That's one of the key values that we have is we want to be a strategic partner alongside you in the benefits, and we want our TPAs to match that. Now, a certain TPA that we love for one organization, the other organization has maybe tried and didn't like, for instance. So we have a set, I would say 3 or 4 that we feel really comfortable. But the big piece of that is we are always looking for independent TPAs, independent pharmacies, just because we found that that's a lot more transparent and they're more willing to have customized approaches. I don't know if anything you'd want to touch on top of that.
Nope.
Okay. And one thing that I would say about the one thing with the surgery centers and the imaging, a lot of the times, not only are these, surgery centers just great centers of excellence in your areas, they're also sometimes the exact same surgeon that would be doing the procedure in the hospital setting. They may work in the hospital for Monday, Wednesday, Friday, and at the surgery center for Tuesday, Thursday. So you can actually get a lot of the similar outcomes just and you'll see an example here, a much lower cost as well too. So definitely a key there. The other ones that are a little bit more specialized that we've seen, I know at Ellerbrock in particular, one of them being renal dialysis. So dialysis patients are very expensive on a medical plan. So how can we best find them solutions that, again, are going to increase, if not keep their benefit the same, but then also reduce the risk from an employer's perspective ongoing? So we've got a few different programs in place that we have advocacy mixed with in-home care, mixed with a variety of different programs that can help an employee from that perspective. The other one that I think is a really unique one that we're really starting to dive into more and see is high-risk pregnancies. So being able to get programs in place to ensure that we're limiting as many high-risk pregnancies as possible. So this isn't taking the place of an employee going to their OB. This is just another third-party fetal specialist that can help answer questions, that can help guide a mother and just along through the process. One unique thing about this that we always get eyes raised in a meeting is if an employee that has this type of a program goes through that, they're able to have a year's worth supply of diapers for free. So like that's their incentive to do it,
Yeah.
right? And then lastly, this is more from a CFO perspective. With self-insurance and with partnering with the right kind of partners, if you will, we're able to audit claims above a certain level.
Mhm.
That is something that is huge on the fully insured and level funded side that you really don't have a lot of visibility into. Whereas on the self-funded side, we can make sure that there's an audit on the back end. And that's not even error by malice or anything. Sometimes there's just billing code errors that we wouldn't be catching on the fully insured level funded side that we now have visibility into on the
Lots of dollars sometimes too.
significant
Lots of
dollars.
Yeah.
For sure.
And I think too, because we just talked about some tools, and I just want to reiterate and stress this, none of this is designed to disrupt the culture, disrupt, the team. Like there is a process by which, our team or anybody you're working with should go through to understand your culture, understand your team, understand your goals, and then implement the strategies to not only reduce costs, that's a lot of what we're focusing on, but actually increase the benefits to those employees, but limit disruption.
Yeah, absolutely. Well, and the beauty of these programs are, these are programs that we have for our self-insured employers, but they don't have to utilize those, or they don't have to use every single one of them. So if they want to ease into some of them, that's completely fine. It's just being able to educate around all the programs available and how do we properly use them. And I think it actually goes into one of the questions that just came through of, have we seen difficulty in providers accepting the self-funded insurance? It's a outstanding question. I would say that the only difficulty we've ever seen was really when we're unbundling self-insurance. So on the fully insured side, if you're with Blue Cross, you're with Blue Cross. On the self-funded side, we have the ability to have Aetna be the network, and a TPA like Ameritain would be the claims payer. The only difficulty we've ever seen at like a doctor's office is sometimes the front desk individual or the person doing billing is really used to saying, oh, well, I'm just going to go validate insurance with Aetna. Where in reality, we actually need them to validate it with the TPA. And it's on the insurance card. So it definitely gets fixed easily. And it's something that we educate during open enrollment if we have a situation like that of just saying, here's an example of your ID card. Here are 2 or 3 of the questions that you may get, and just making sure that they feel confident through that. Now, most times when they see Aetna and then they'll look at the card again and see a different TPA, they'll say, oh, okay, I need to call this one. And they make the change for them. But that is where I'd say we see most difficulty. I don't know if you have anything to add to that.
No, I don't. Good question though.
Yeah, very good question. So the direct contracting is one of the things that we talked about. So advanced imaging and surgery centers having those programs. This is an actual example of one of our employers. We trying to de-identify everything, but we've got a hospital system in the Midwest, and then we've got a surgery center in the Midwest as well too. So one of our employers had an individual that went through and had a hip. They had actually had to have a double hip replacement. So they went through and did their first hip replacement without reaching out to the member advocate, without kind of evaluating the options there. That cost of the surgery, the billed charge was, as you guys can see here, over $300,000. And then after the discount of what Aetna had, it was about $190 that was going to be paid by the plan. Now that was paid by the plan and then also by the patient for their deductible and co-insurance pieces. We were able to see the data, show that that individual had a hip surgery. We went to the employer and said, hey, this is a great education point. Let's educate again about, we need to be reaching out to the member advocate. We need to be taking use of these programs because it could save us a ton of money. That individual was like, hey, I have another one because I'm having a double hip replacement. So he went through the proper, kind of avenue to do that. They had the same surgeon, kind of this situation that we were talking about, the same surgeon do the procedure just at a surgery center instead of the hospital setting. So the second one, we actually got, it sounds weird to say we got quoted, but we were able to see what the bill charge would have been and what the network would have allowed comparative to going through one of those zero cost programs at a facility center here and around town. The pre-negotiated rate, as you guys can see, is right around $24,000 for that same procedure. The beauty of this structure is that surgery center did not make any less than what they would have made on the insurance side. They set the pre-negotiated rate. They set what they feel comfortable with, and we just have an avenue to go out there and make that happen as a claims payer, as a benefits advisor. And the big thing that I think we talk about is making it a true benefit. The patient pays $0 for that second surgery where they already paid that $8,000 out of pocket. And I know we have a lot of clients, a lot of prospects that $8,000 to an employee in the course of a year is significant. So we're able to provide those types of arrangements in those types of programs for employees.
Well, and you mentioned it earlier, you have a couple successes like that and people talk about it. The rest of your team starts to understand and learn and hear and ask questions. And all of a sudden we've got people becoming better consumers of healthcare.
Absolutely. Yeah. And a lot of these surgeries that we're talking about or procedures, what we're trying to do on the self-insured side is hit the high cost claimants or hit the higher cost issues and then educate around your everyday ones like the urgent cares, the emergency rooms. Not everybody's going to have a surgery, but we're definitely going to still all have to be better consumers of health insurance. The other example that we have here, very similar situation, but it was with a more simple surgery. So this was just a very simple hernia surgery that I think the procedure we found out took like 14 minutes or something. Very, very simple. But went through a hospital system. This would have been billed right around $61,000. When we were able to go through a surgery center that was able to specialize in these types of surgeries, it was right around $10,000. So again, just these simple procedures, colonoscopies, hernia surgeries, those types of things can be impacted by this as well too. We always like to do the breakdown of the travel costs or the kind of the outside of the surgery costs, because if we ever have to have an individual travel, if we ever have to have an individual stay overnight, if they need to travel to Texas or wherever that would be, that all gets paid for by the plan and is still a $0 cost to the employee as well. So again, always trying to incentivize the employees to have that behavior as well as never taking benefits away from them.
Absolutely.
Great question. Somebody said, what if we have employees in different parts of the country? It's an awesome question. What we typically do is we like to have a national network be at the heart of everything. So, your national networks are going to be around Aetna, Cigna, Blue Cross. Those are kind of the main national networks that you're not going to have much issue with across the board. Then from there, any of the direct contracting that we do, we really like to see what your demographic is and then see what we have available in that area. If there's not a lot of surgery centers that are available in that area, how close can we be? And then if we really can't get within a certain radius, are there any ones that we should be reaching out to? That's the beauty of the self-insured arrangement as well as that control. Us as a benefits advisor, you all as an employer, if you have a contact at one of those surgery centers, we've done it a handful of times this year, where we can go to them and say, are you guys interested in doing bundled rates or direct contract where we essentially pay a cash price, if you will, to have surgeries done? And it allows us to be able to be flexible. So that's a great question.
Great question. Our team is there to help navigate that. And obviously the advocacy teams as well. They know the geography. They can speak multiple languages to overcome those potential barriers. So a lot of tools to be able to navigate across state lines and different language barriers.
Yeah, absolutely. Trying to keep it as nationwide as possible, but then customized to your specific demographic. So, talking about all the different programs that are available or, just ways that we can impact those claims, when we think about the long-term approach is really what I would say on the next slide here. There we go.
Clicker is not one word.
The clicker is not our friend today. So we talk about long-term strategy. Here at Ellerbrock, we're always looking at, we're not making decisions in silos. We're not making decisions in a 12-month window. We really want to look for ongoing. Our special guest will definitely talk through what you need in place to have a long-term approach at self-insurance, because it's not a one-year thing. This is a chart of one of our clients that allowed us to go all the way back to 2013 when they made the decision to move self-insured. The key piece here is the average trend over the past 10 to 15 years on the fully insured or level funded side is right around 10 or so percent. This individual employer was trending actually a little bit better. So we used 8 here. So if they took their average cost per employee and trended that out 8% a year, we're looking at the red line there. Now, when they moved over to the self-insured side, there are years here, which is kind of the beauty of self-insurance. There are years that are slight increases, there's decreases, there's significant increases, but over the course of that 10 to 11 year period, they were trending at 3.5. And making that decision really, really ultimately saved them that accumulation of dollars. I mean, we're talking significant dollars here. And it's that long-term approach that we really want to educate on and also keep going back to over the course of time of like, here's when you made the switch, here's where it is now, and really being able to look and validate the decision.
Yeah, I mean, I think for us, one of the big things was having the ability to put a long-term strategy in place. And that's what this is showing us. But I think one of the things that always became so obvious to me when we started breaking this down is you're going to have peaks and valleys, right? And you see that in that bottom line. And of course, that's going to be based on performance at the time, right? We're going to have years where we have more activity. We're going to have years where we perform better. The funny thing is that if we're in the fully insured market, the same thing is going to, if we have a bad year, how do you think the insurance company is going to react? They're going to react in that next year by giving us a massive increase, or even better. This is always my favorite thing is, you mentioned the 10%. Some people say, well, geez, we've had 0% or 2% or 5% over the last several years. That oftentimes is telling you that may be the best time, or you've missed a massive opportunity to be self-funded. Because why are we getting no increase? It's because the insurance company has been awfully profitable for the last 5 years. It means you performed well.
Yeah.
And you probably don't even know it.
Absolutely.
And so those are the things that I think, when you can understand there's going to be peaks and valleys, understand, again, the risk tolerance protection that's in place, and build a long-term strategy and understand how that's going to allow you to achieve goals as an organization. That's what this allows business owners and the executives to map out.
Yeah, absolutely. And do you feel like, obviously with only, this is 10 to 11 years worth of data from your perspective, what would you say at Ellerbrock would be kind of to the tune of this?
Yeah, we've been able to reduce costs. And our perspective, and I think a lot of our employers, our clients that we're giving advice to, perspective is when we're able to reduce our direct costs, we turn around and reinvest that back into our team. So, we've done things like added benefits that we didn't have before. Well, we're able to do that. We've also not increased our out-of-pocket spend for at the employee level, and we've even reduced it at like family, employee, spouse, children. So, but that's reinvesting. We've been able to do that because we aren't stuck in that red line of continual increases. We're able to control costs and turn around and say, all right, we want to reinvest that back into our team. And oh, by the way, we've got enough data. We've seen the tools and levers to help us have success. We also know what matters to our team, so we can reinvest in the most appropriate ways too. So that's been our experience.
Yeah, absolutely.
And we're really proud of it.
Yeah, for sure. So one of the key pieces is, when do we start evaluating this? Here at Ellerbrock, proactive education, we've always found to be the best. And just making sure everybody knows what are the different options. I think if you look at a group like we talked about here, 20 plus employees. Now, are you going to be going self-insured at 20 employees? Maybe not. Will a TPA quote that, or self-insurance quote that? Maybe not. But knowing, most 20 life, 30, 40 life groups know the difference between fully insured and level funded. So we always say that you should add to that as well and know the difference and know kind of the arrangement of self-insured. Where we really start to see TPAs, pharmacies, as well as stop loss have appetite to quote is at 25 plus employees. So kind of to your point with Ellerbrock, at 30 employees is when we really kind of took the jump. That's very similar to what we see. Now, 10 to 15 years ago, I would say that number would have been 50, 75. But with the trends that we're seeing, employers just want to take more control. They want to add more, more cost containment mechanisms to their plan. I don't know if you want to.
Yeah, I mean, to be quick, so we have time for our guest. All I would add to that is if you're not thinking about it, regardless of size, if you're not educating yourself around the topic, you're not thinking about it, and you're not trying to forecast how it could make sense at some point, I advise you do it.
Yeah.
Regardless of size, even if it's something that can't happen now, and is in the future, start to learn, start to educate, and start to think about what it can mean for you.
Absolutely. And the last piece here is, and our guest is definitely going to talk about it, the culture and the communication matter a ton too.
Yep.
So financially, that's one thing. It's a whole new mechanism. We want to make sure we understand the finances, but we also want to make sure that we're able to communicate it appropriately. And that's where you lean on your partners. That's where you lean on your benefits advisors to help, we've been through this multiple times. This might be your first time as an employer. So how do you kind of lean on us to help? And then lastly, the one thing I would say is, oh, there is a sneak preview. This clickers.
Cat's out of the bag.
But the common hurdles that we have to evaluating. So when you come to us or you go to your benefits advisor and you say, hey, I want to look into it. I want to start getting educated on it. The education, there's no hurdle for, right? The other piece is we want to engage with the right partners. So we want to make sure in that question of, do you recommend somebody for a TPA? Yeah, we do. You want to make sure why are those being recommended and making sure that they're transparent, very honest reasons. The other piece is when you're coming from fully insured into or level funded into self-insurance, data matters. So if you're not able to get proper data for an underwriting team to feel comfortable to quote, that doesn't always mean that you're out of luck. There's different ways that we can go about it. Health questionnaires. So having employees take surveys to essentially just get underwriting a little bit more comfortable with things. I always like to refer to it as the ticket to the dance sometimes, where if you want to get into self-insurance, you might have to do this the first year going into it to make sure that underwriting can feel comfortable with it. And then lastly, you've hit on it a few times, it's the disruption piece. Making sure that employees feel educated, empowered, as well as what we're providing in the programs that we're offering are equal and most times a better benefit. Those are kind of the key pieces that we see.
100%. The only thing I'd add here, the engage the right partners. This is not a one size fits all strategy, right?
No.
Everybody's, whether it's TPA, whether it's network, PBM, whatever, that is going to be different for everybody based on goals, based on situation, based on all the things.
Yes.
And so I think just making sure that you're working with somebody that can help you identify who the right partners are to allow you to achieve your goals. I mean, that's a huge piece of it. So
absolutely.
that's what I'd add before we bring our guest on.
Exactly. Yeah. So without further ado, we'll slide on over. So we've got Amy Luckenbill here.
Let's see if we can all
squeeze
in.
If we can squeeze in. Yeah. We've got Amy here in the studio. But really, Amy, just for everybody on, give a little bit of background on yourself, and who you're working for today. And then obviously we'll dive into some pieces of how you guys decide to go self-insured and what you think.
Okay. Amy Luckenbill. I am the Director of Human Resources for Keystone Glass Company. We are a commercial glazer and exterior finisher in the commercial construction world here in Omaha. And we have less than 100 employees, so we are a small employer, and our membership is about 66 belly buttons, as we like to say. But we sit around that number for our folks who are purchasing medical insurance.
Absolutely. And for you guys, what was kind of the tipping point for you to where you're like, okay, we're kind of done with this fully insured thing. We're really looking into self-insurance, and then to really just hop off the edge and go for it?
Yeah, we really didn't have a choice. I mean, it was a choice, but I came on with Keystone at the end of 2019. So the open enrollment process or the decision-making process around benefits had already been completed at that time. And then 2020, COVID hit, and everything about our industry was very speculative.
Yep.
We continued to work. We were essential for the economy. And so we continued to work and do all the things we were normally doing. But when our renewal came up for 2021, mid 2020, we got a 25% increase quote. And we, being a small employer, were already kind of maxed out on that spend and what was reasonable, what we felt was reasonable for our population, and we just found it to be untenable. So we have an owner who's a CPA and very strong in the numbers game. He understands all the things. And he's also probably, I would say, less risk averse than the average business owner. He's comfortable, probably more comfortable with risk than I am even. And it was it was really for him, I think, more a question of, to me, is this something you can handle?
Yeah.
And that was then a question for me, is this something I can handle? And I'm pretty astute, but definitely in the benefits sphere, it was not my strong point. I was raised by a medical coder, however, so I have a deeper understanding of how EOBs work, and employee education around benefits was always really important for me. So I probably go a level or two deeper with that than the
absolutely.
average HR person, right? So I knew I was comfortable with that, and I knew that our broker at the time was not doing anything to help us with that 25% increase. And so Ellerbrock-Norris was our property and casualty and business insurance broker, and we already had a really strong relationship with them. So I leaned on Jason and said, well, you know, how much do you trust your broker? Really is the question, and how much do you trust them to not let us fail in this area, right? And he's, I'm good. And I said, well, I'll dig in and figure it out. And it's been a great relationship the whole time. So we didn't have a choice, 25% increase.
Yeah.
And then I carved some things out of my normal bucket of work to make space for it. And that is key for your folks. They have to carve out a few hours a week to make sure that they're scrubbing the data and understanding how everything works and staying in good communication with the team about the claims as they're coming in.
For sure. And what do you think was a key, one or two like key misconceptions that maybe you even had going into this, or Jason as your CFO, that now you know differently?
Right. I'm going to reveal all. I knew nothing about self-insurance. I didn't come from a benefits background, so I'll figure it out.
Yeah.
Right. So I didn't have any preconceived notions about it. I think Jason probably had more background, you know, talking with Andy about this as a possibility. But I had never gotten real deep into benefits at all. So everything was a learning curve, start to finish for me.
By the way, we can see the questions that there are. If you will get to them, we want to obviously let Amy continue to chat, but I just want everybody to know we see the questions coming in. We'll circle back toward the end.
For sure. So, and for you guys and what you have going, and when you made the shift, did you feel like you kind of went a little bit away from reactive to more proactive with the data? Like what do you think your take is on it?
The data takes some time to flush through, right? So to be honest, that first 6 months is a little you see the claims data start coming in your weekly reports, and you know, at the beginning of the year everything's pretty clean and yay, look how well we're doing. Well, it's the beginning of the year, we're still busy washing claims from the previous year. And then, you know, April, May, June, your eyes start to get very big at the numbers until you understand what the numbers are telling you, right? So for all of our HR folks on, when someone brings you data, you say, well, what's the narrative about this data, right? And someone brings you a story, you say, well, bring me some data to back up your story. You always want those things to be matched up. And then when the data started washing and we had a better understanding of our utilization and where the dollars were going, then we went, oh, that's why we had a 25% increase. Because we could start to see what UHC, who was our carrier at the time, was seeing and why they were giving us the increase they were giving us. And so there's a definite learning curve, and you have to be comfortable, you know, kind of not understanding until you start to marry the data with the narrative to make it make sense. And then once we had those things in place, then it was so our experience was in that first year that specialty prescription spend was 80% of that's an untenable balance. And so then we started pulling those specialty RX levers, looking at new PBMs, and the dollars, just everything just kind of evened out. And that was our major issue that we had to address in order to stabilize. But once we understood what was going on, we were 9 months in and we were fine.
Yeah, and it kind of it goes back to why we always talk about independent TPAs, independent PBMs, because you're able to have that freedom and flexibility to go out and do those changes. Do you feel like you talked about it of your guys' size? How do you think that you as an organization, how have you guys gotten over the preconceived notion that we talked about of you're too small, kind of like Ellerbrock in a sense as well too? Have you felt like there's any sort of hurdle at all?
No, not at all. If anything, your fully funded carriers are charging you a premium for being small.
Yeah.
They're already charging you because you're small. And so if you can gather up some more control over those dollars, you're subverting that, what I consider to be unethical behavior, but
that's for a whole nother.
That's another webinar. Yeah.
And then, I mean, lastly, you guys made the decision, you took the dive, we always talk about long-term moves, right? How have you felt like now, granted, in your year one, it was a short-term, like, this is way better than our 25%, which I totally understand, but how did you feel like that's now evolved over the long term that you've been on for 5 years roughly?
Yeah. So 2021, we actually came out with our final spend. I did some more numbers from our conversation yesterday. It was a 4% increase. So it was much better than the 25 that we were quoted. And that's with $120,000 going toward a specialty prescription.
Right,
Yep, $10,000 a month. So we would have, had we understood what we needed right at the beginning, we would have saved conservatively 20% that first year. And so then when you think about the exponential curve, we would be way off the charts by now. So, and having 3 years of data under our belts, we then had something to take to another captive and get an even better situation for ourselves in 2025. And so as I look at our numbers right now, we're less than 1% higher than we were in 2020.
Wow.
Projected for
That's pretty
2025.
awesome. For sure.
Ringing endorsement for us. That's not to say it's not work. You have to stay involved. You have to be reviewing your claims. You have to be, the number of emails that I send to Kevin and the team. Hey, this looks fishy to me, and explain to me what's going on. And they are back with me within a day or two. And oh, okay, that makes sense. But I'm the first one looking at that data because I know the narrative of what's happening in my organization.
Yeah.
I see the data married up with the narrative, or I go, oh, hey, we just had a heart attack on staff, know that this is coming. And I put the team on notice that they need to be managing that case. So again, narrative data married together, which you do not have in a fully funded platform.
You bring up a good point of the size, actually, like the size of an organization, sometimes being in the small to mid-size actually may be beneficial, because
everything.
When somebody comes to you and says, "Hey, I've got to have a surgery next month," you're able to say, "Well, did you, go through the proper channels?" So I think that it does present itself pretty well. Go ahead.
Should we?
Sure.
Try to get to a couple questions.
Yeah, for sure.
Quick, not to cut it off, Amy. That was amazing. Thank you for that.
I love to be amazing.
You always are. Maybe real quick though, we don't want to leave. Go ahead, Kevin.
Yeah, it looks like one of the questions was, as a small employer, what suggestions do you have for managing the level of funding compared to overpaying? It is scary to consider that a year may not be funded enough, but I can see where an employer would think that low claim year could have a future decrease in funding, which might not cause a longer term problem. That's a good question. And so what we do on the front end is what we always want to do is set budgeted rates that would be very similar to a fully insured arrangement. Some people call them fully insured equivalent rates. So we're going to set that budget at what you feel comfortable in terms of what we're hearing from underwriting for that expected claims costs, as well as if there's like, hey, we just want to budget a little bit more than that just to have some security. The big difference is like Amy had said, when they had a claims year where they saved, they actually saved. It was real dollar cost that was not coming out from the budget perspective. Whereas on the fully insured side or level funded, when you're paying that premium, the chances that you're going to get a decrease next year or, truly see that savings is pretty slim typically. And then what if you're 27 employees? I would say that starting to educate around it and just getting a little bit more education is great, because now the appetite to quote may not be there, but definitely can go out to market to see what it looks like, and have that understanding. And then one of the last ones is, what can you include 1099 contractors on the program? Really, really good question. 1099s are a little bit difficult when it comes to benefits, just because of the fact that they're not technically employed by the employer, as you well know, asking the question. So there's some ways that we can do some carve out stuff. Having it be directly through your self-insured plan is not something that we typically see a ton, but there are some different programs and mechanisms that you can kind of pool onto what you're doing with your normal population as well as your 1099 contractors. So that's a great question actually as well too. So
look at that. We got through all that and only 30 seconds over.
Yeah.
I was just going to say, Kevin, I can speak to the funding part on the employer side.
That'd be great.
We were given suggestions. So when we shifted into self-funded at first, we kept everything from the employee perspective the same. So we increased nominally what would have been in what they would have expected, 5 to 7%, I think somewhere around that for each of the, employee and children, increased them at a rate that they would have felt was tolerable, right? So we still did an increase. And then we could choose how aggressively we wanted to fund
Based on scenarios.
Right. And so we knew what our health situations were. And we funded pretty aggressively the first year because we didn't want to be in a bad situation at the end of the year. And even with that RX spend that was so high, we still had a pool of money, a surplus sitting left over that we could then go, oh, we're actually going to reduce our premiums. We're going to reduce our max out of pocket. We're going to reduce our deductible. And we also, gave options of tiers. So we had the same plan for every employee, but then they could decide, do you want a really low deductible with a higher premium? Do you want something midline? We gave 3 options so that we could give ourselves lots of different options for going forward. And we've stabled out, we have 2 plans, and some folks are comfortable with a little more risk and some folks want a really low deductible, but those deductibles have come down, the max out of pocket has come down, their premiums for payroll have been largely stable. And so, but in the beginning, that first year, they did not know we were going self-funded. They just knew we were changing carriers. That was the only change we made. But I managed that from the HR side, saying we're not going to change an FSA. We're not going to change this. We're
limiting
not
the
change
change.
that. We're going to make the changes over time and in baby steps so that it isn't disruptive to the employees and so that they don't feel unsettled about anything that we're doing. That's not something that we want to make people feel
for sure
in the workplace. We want them to just have it work.
I think that's a good way to summarize the entire
say,
conversation, right?
But
well, hopefully people stuck with us. We went a little over time, but that was Amy. Thank you.
Yeah, absolutely. And know that if there are folks out there who have questions from an HR side, clearly I'm an advocate for Ellerbrock-Norris and I'm an advocate for self-funded mechanisms, but I'm happy to talk with folks individually about their experience and some things there are some additional things that from an HR perspective you should be thinking about and planning for, and I'm happy to share those with folks.
Well, we appreciate it
individually if they
Absolutely.
decide to go deeper.
Absolutely. Well, yeah, and again, thanks so much for taking the time to kind of learn with us here. And As a follow-up, if there's any questions, very similar to what Amy has said, any questions or anything that you want to really dive into a little bit deeper, feel free to reach back out. I know our marketing department's going to be sending out this recording as well too. So if you look at something and have a question on it, just feel free to reach out to us. We'd be more than happy to talk. So
Awesome. That was fun.
yeah, absolutely.
Bye, everybody.
Thank you.